Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
Okay, let's dive right in. Today, we're tackling what is probably the most polarizing stock in the entire AI infrastructure space, CoreWeave Inc., ticker CRW. It is a true battleground, and you can see that just by looking at its chart.
Oh, it's absolutely extreme. I mean, we're looking at a beta of 2.26, so it's moving more than twice as violently as the rest of the market. Right now, mid-January 2026, CRW is trading at what? Around $98.51 a share, and we just saw this chaotic spike, a 12% rally, a gap up on January 12th, and that was, directly after the CEO went on a PR blitz to fight back against the short sellers.
Exactly. And that volatility, it really points to the deep intellectual divide here. The company's valuation is swinging wildly between $45 and $50 billion. So that brings us to our central question for today. Does that valuation actually reflect an indispensable, sticky, neo-cloud utility with a real specialized moat?
Or is this valuation just fundamentally unstable? Is CoreWeave, at its core, just a leveraged, financially engineered asset rental company that's, destined for a structural collapse as its hardware depreciates and compute prices inevitably fall? I'm firmly in that latter camp. My focus is entirely on the structural risks and, frankly, the questionable governance.
And I'm on the other side of that trade. I see the current price, $98.51, as being deeply corrected. I mean, it's trading a shocking 47% below its 52-week high of $187. I think the technical setup, specifically that extreme short interest, combined with the company's specialized infrastructure, positions it for a massive move higher if management can just execute. My view is pretty simple. CoreWeave is not just another data center company. It's a critical piece of the AI supply chain. They are a specialized neo-cloud utility that's absolutely essential for training and deploying the world's biggest and most complex AI models. And this isn't because they have a lot of servers. It's because they have this deep expertise in a very specialized infrastructure stack that, the big hyperscalers find really difficult and slow to replicate. I'm talking about things like liquid cooling and, critically, InfiniBand networking.
Could you just quickly clarify for listeners why InfiniBand is the moat there? Because that's a technical term that gets thrown around a lot.
Yeah, absolutely. So your standard cloud networking runs on Ethernet, which is fast, sure. But when you're linking thousands of GPUs together to train a frontier model, say a 100 billion parameter model, the latency just becomes crippling. InfiniBand is the high-speed interconnect that lets these huge GPU clusters talk to each other like they're one single giant supercomputer. That is what the big AI labs are paying huge premiums for, and it's why CoreWeave has such a massive revenue backlog. And with the stock trading almost 50% off its highs, I really believe the downside risk has been more than priced in. On top of that, the technical setup is it's incredibly compelling. Short interest is at 20.76% of the free float. That's 52.84 million shares shorted. That is a massive, concentrated pile of fuel for a short squeeze if CoreWeave gets any kind of good news.
I see why you think that, I do. Especially when you focus on the technical catalyst of a squeeze. But I'm coming at this from a completely different, let's call it a forensic finance angle. I just contest the durability of that neo-cloud valuation. Look, the company is structured to exploit a temporary inefficiency in the market, the GPU shortage. Once that bottleneck eases, and it will, the fat margins CoreWeave enjoys are just going to evaporate as compute becomes a commodity. I mean, the seminal short thesis from Carousel Capital, Artificial Returns, argues pretty persuasively that CoreWeave is really just a leveraged arbitrage vehicle. They borrow a ton of money, they buy GPUs, and they rent them out at a premium until the hardware is worthless. Now, that works great if demand stays vertical and your cost of capital is low, but it builds in this deep structural fragility. We also have to talk about the customer concentration risk and the very controversial round-tripping relationship with NVIDIA, which bears argue just paints an artificial picture of demand. And then you add on top of that the management team's background. I mean, CEO Michael Intrater's history is in commodities trading. This suggests a mindset focused on trading volatility, not on long-term innovative company building. Let's start the core debate with the most toxic risk factor of all, hardware depreciation. The entire financial model here rests on an accounting assumption that is, well, it's deeply suspect. The famed short seller Jim Chanis has been hammering this point. CoreWeave depreciates its incredibly expensive GPU assets, like the H100s, over a very generous 6 to 7 year period.
And why is that specific length of time so critical to your argument?
Because of the pace of technology. I mean, look at the jump from the A100 to the H100, and now Blackwell is coming. For state-of-the-art training, the kind of work that commands the highest prices, these chips are functionally obsolete in just 3 to 4 years. So if CoreWeave were forced to use a more realistic depreciation schedule, say 3 or 4 years, the math gets ugly fast. You shorten the useful life of an asset, the annual depreciation expense jumps dramatically. By Canos' math, that doubled expense would effectively wipe out all of their reported profits. It would immediately drive their return on invested capital to 0%. Their profitability today is basically an accounting fiction based on this stretched timeline. That's the leverage point of the entire bear case.
I'm just not convinced by that line of reasoning because it ignores the economic reality of the market they're in. That 3-year obsolescence theory, it's fundamentally flawed because it assumes these chips are only valuable for one thing, training the newest, most cutting-edge models. And that's just not how their customers use the hardware. CoreWeave's management has given a really strong rebuttal to this. Older chips like the A100s, they retain a ton of economic value for inference workloads, for actually deploying and running existing AI models. That market is growing exponentially, and it's much, much larger than the niche training market. So as the world fills up with AI apps, the need for stable, low-cost inference compute is going to scale massively. Their ability to recontract these older assets for inference is precisely what justifies the longer 6 to 7 year economic life. They've built the business to capture value across the entire asset lifecycle. It's just a more diversified revenue stream than you're giving them credit for.
That assumes stable demand for older inference chips, which, well, that's a big assumption when new, more efficient hardware is coming out all the time. But let's look past the accounting for a second and talk about execution and governance, because the operational failures here, they deeply undermine any argument for durability. I'm pointing directly at the Denton data center debacle. This was supposed to be a flagship project with Core Scientific, a key part of a massive contract. And this wasn't some minor hiccup. According to documents from the securities fraud lawsuits that followed, Core Scientific started flagging capacity delays from design revisions and even weather as early as February 2025. So, despite knowing about these compounding problems for almost 9 months, CoreWeave management kept their optimistic revenue guidance. They let investors believe everything was on track until the Q3 earnings release on November 10th. And then boom, they finally disclosed the delay, and the stock drops 16%. The timing it suggests a critical lapse in governance, choosing to keep the market happy rather than providing timely, accurate information.
Look, I acknowledge the Denton incident was severe, and the disclosure timing was, well, it was highly problematic. There's no way to spin that. But we have to put it in context. This is a hyper-growth company in a field where supply chains are a mess, and scaling this kind of infrastructure is incredibly hard. This was a temporary delay related to a third-party developer, Core Scientific, in a frantic race to scale. Was it an execution failure? Yes. But was it a structural flaw in the business? I'd argue not necessarily. It's the kind of painful mistake you make when you're growing this fast. And besides, if governance were fundamentally broken, I don't think you would have seen the market react the way it did to Intratorta's recent media tour, that 12% rally on January 12th. Investors still seem to view him as a capable operator who can fix problems. Now, let me be clear. I absolutely agree that the data on insider selling over 2,000 sales transactions and 0 buys in 6 months sends a really troubling signal. But you have to weigh that against the fact that the institutional analyst community, the people whose job it is to model these risks, they still have a moderate buy consensus on the stock with an average price target of $123.81. They seem to think the risks are manageable.
That price target feels optimistic when you look at how the bearish pressure is being applied. You keep focusing on the short squeeze potential, but we need to understand who is doing the shorting and how. The data shows a huge portion of the short volume, between 53% and 59% in recent days, is being executed off-exchange in so-called dark pools.
And why does the venue matter? A short is a short, isn't it?
It matters, because that is the signature of sophisticated, heavy institutional capital. We're talking major hedge funds. Dark pools are used to hide large block trades from the open market. So this isn't just retail traders betting against the stock. This is powerful institutional money building a huge short position opaquely. And that tells you two things. One, they have deep conviction in the fundamental weaknesses we've been talking about. And two, they have the resources to maintain this pressure for a long time. The bear case here is highly organized.
I just come at it from a completely different angle. I agree that institutional shorting is intense, but we should focus less on the venue and more on the sheer pressure cooker that it creates. It doesn't matter if they use dark pools or the lit exchanges. That 20.76% short interest is still borrowed stock that they have to buy back eventually. That positioning is what creates the extreme volatility. It's a technical time bomb just waiting for a catalyst. And what's more, if you look at the valuation comparatively, CRW is already deeply discounted. It's trading at a price-to-sales ratio of around 8.5x. Now, compare that to its peers like Applied Digital, which often trades closer to 30x or even 40x PS. That tells me the market has already baked in a lot of this perceived risk, the shorter asset life, the operational complexity. So the market has punished CRWV for its asset-heavy model, even though its specialized infrastructure is arguably much more critical than a simple real estate landlord. That disconnect, to me, is the opportunity. So to briefly sum up the bull case, CRWV has an essential specialized role in the AI build-out. It's protected by a real infrastructure moat in liquid cooling and InfiniBand. The downside risk, I believe, has largely been priced in, with the stock nearly 50% off its high, and most importantly, the massive short float creates this extreme technical pressure that could lead to a very powerful, very rapid revaluation if management can just stabilize execution.
And conversely, the core of the bearish argument really rests on that fundamental flaw in the financial model: its reliance on a questionable 6 to 7 year depreciation schedule. A schedule that we argue is just completely vulnerable to rapid technological obsolescence and the eventual commoditization of compute. And this financial fragility is then made worse by real governance risk, which we saw with the delayed disclosure around the Denton data center failure.
So we're left with these two powerful opposing forces. You have the high-octane technical potential driven by that incredibly crowded short position, a real-time bomb for the bears,
versus the complex fundamental risks that are tied directly to the integrity of their accounting and their ability to execute. Ultimately, the long-term viability of the stock depends entirely on one question: can the demand for this specialized compute truly justify that 6 to 7 year economic life for rapidly evolving hardware? And that is the core uncertainty investors have to resolve.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching, and see you next video. Bye-bye.